In this lesson, we're going to discuss what companies do when they decide to make an important change in how they account for things. These changes fall into two primary categories: a change in accounting principle and a change in accounting estimate. They sound similar, but generally accepted accounting principles, or GAAP, requires them to be treated very differently. Your goal is to learn which treatment goes with which change and how to apply it. Here's an incredibly common situation. A company has used LIFO, last in, first out, to calculate ending inventory for years. But this year, management decides FIFO actually paints a truer picture. Fair enough, GAAP allows a change if it's justifiable. But now there's a problem. Every prior year income statement in the comparative financials was built on LIFO. If this year is FIFO and last year is LIFO, the two columns aren't comparable. And comparability is one of the underlying principles that GAAP was designed to achieve. Were last year's statements wrong? No. LIFO was perfectly acceptable when they were issued. But wrong and no longer comparable get the same medicine. We redo the past. Redoing the past sounds more complicated than it really is, though, because if you think about it, the entire past is just sitting in retained earnings. Any changes we need to make to revenue and expense that were recognized in the past can simply be made to retained earnings. Problem solved. A change in accounting estimate, revising a useful life, a salvage value, an uncollectible percentage, or a warranty rate, gets prospective treatment. No restatement, no adjustment to retained earnings, no apology. Estimates were the best guess available at the time, and new information doesn't just make the old guess an error. We simply use the new estimate from this point forward. One trap to watch: a change in depreciation method, say double declining balance to straight line, is treated as a change in estimate, not a change in principle, because the method choice is really an estimate of how the asset's benefits are consumed. Prospective. For a change in principle, the work is three moves. Move 1, build a small table of the difference the new method makes year by year, for every year before the change. If we're going from LIFO to FIFO, that's the difference in cost of goods sold each prior year, which is also the difference in pre-tax income each prior year. Move 2, record one journal entry to bring the accounts up to the new method. The total of your difference is the cumulative effect, going from LIFO to FIFO. FIFO's cost of goods sold was lower, so cumulative income and inventory would have been higher. Debit inventory, credit retained earnings for the total. Move 3, recast the comparative financial statements. The prior year column gets rebuilt with the new method's numbers, and the earliest beginning retained earnings shown gets adjusted for the cumulative effect of everything before it. Let's look at an example of a change from LIFO to FIFO. We're going to make the journal entry to update the financial statements, and we're going to draft the new comparative financial statements by adjusting retained earnings for the cumulative effect of all the years prior to it. We'll start by determining the pre-tax income for year 4 under each of the different methods. So if we were using LIFO, we would start with sales and we'd subtract our cost of goods sold number for year 4 using the LIFO system. And that gives us a cost of goods sold of $14.45 and income of $36.55. If we were to switch to FIFO, our sales minus cost of goods sold under FIFO, notice we've got a much smaller number for cost of goods sold. So presumably prices are rising, meaning when we calculate cost of goods sold for the things that we have sold, we're considering the first ones we purchased, lower prices, giving us a lower cost of goods sold, but a higher income. And then using average cost, we would take year 4 sales and subtract $12.05 for average cost. So notice that one falls right in the middle in terms of income, and LIFO giving us the lowest is often used for tax purposes. So again, notice that under LIFO, we've got the highest cost of goods sold at $14.45 because we're considering our most recent purchases as what we have sold, last in, first out. And so when we go to prepare the journal entry, if we were to switch from LIFO to FIFO, we need to figure out what the difference is in those cost of goods sold numbers for each of these years. And then I'll just carry this formula down and add it up. So we've got a difference here of 720, meaning under LIFO, we have recorded cost of goods sold higher than FIFO for the 3 preceding years, right? Preceding year 4, we're in year 4. So we can record cost of goods sold for year 4 at $14.45, but we need to prepare a journal entry to fix retained earnings because it has 720 too much of cost of goods sold in it. And when we would have debited cost of goods sold, what would we have credited? It would have been inventory. So we need to debit inventory, and we'll debit inventory for 720. And the credit would go to cost of goods sold if we were in the year that we were fixing this number, but we are not. We're in year 4. So we need to credit retained earnings because that's where cost of goods sold for all of the preceding years is now sitting. And so we'll credit retained earnings, and that will fix our retained earnings balance for the switch from LIFO to FIFO. Now, if we were to switch from LIFO to average cost, the effect is the same. It is a higher cost of goods sold that we have recognized in the prior 3 years. Again, we're only looking at the prior 3 years because we are in year 4. We can record cost of goods sold under the correct method in year 4. And we're going to do the same exact thing. We're going to debit retained inventory and credit retained earnings for the 320 difference, where we had recorded more cost of goods sold than we needed to under the LIFO method. If we're planning on using average cost going forward, then we need to fix the prior years to have put back a little bit of that cost into inventory and adjust retained earnings so that we have less expense recorded. Now we're going to prepare the income statement under each of these new methods, and our income statement is shown comparatively. So we need to show year 4 and year 3. So we're going to grab sales for year 3 from the given information. That was 5240. And now we're going to use the cost of goods sold number that is the correct number based on the new method. So FIFO's cost of goods sold for year 3, 1460. And that automatically adds for us to 3780 as our net income. And then in year 4, we'll do the same thing, grab year 4's sales and year 4's cost of goods sold under FIFO, giving us our income of 4050, which ties out to what we calculated up here for income, pre-tax income for year 4. Notice how we didn't have to make any adjustment to the income statement. We just used the correct numbers. We're going to do the same thing for average cost. We would grab our sales, and I'm just going to grab it from here for efficiency. And then I'll grab the cost of goods sold from up here for year 3, average cost. And then I'll do the same thing, sales, I'll grab it from here to be quick. And then cost of goods sold for average cost for year 4. Noticing that our average cost income is going to be $38.95. It is, so that ties out. Now the retained earnings statement is a little bit different because we do need to adjust the beginning retained earnings balance for the earliest year presented, which we've got year 3 shown here. So we're going to work in the year 3 column for our cumulative effect of the difference. So I'm going to grab beginning retained earnings from the given information up here for year 3. That means it was ending year retained earnings for year 2. And then I'm going to add the cumulative effect of the difference that would need to go into year 3. This is separate from our journal entry. We're just preparing the financial statements. We made our journal entry to fix everything for all 3 years preceding year 4, the current year. But now we're preparing the income statement or the retained earnings statement for year 3. And so I'm going to add the cumulative effect for year 1 and 2 to this statement. So that would be 300 and 230. Then I'm going to add net income, which was calculated right here as 3780, and that shows me the correct retained earnings of 10,135 at the end of year 3. That then becomes my beginning retained earnings for year 4. And I don't have to add any cumulative effect. I've already adjusted retained earnings for year 3. This is correct. Now all I have to do is add net income for year 4. If we had comparative statements that had 3 columns and we were showing year 2 as well, we would put the cumulative effect of the difference in year 2, and we would only be adding the year right before year 2, year 1's cumulative effect of the difference to adjust retained earnings. Again, our journal entry needs to correct for all the years preceding the current year, actually fixing retained earnings. This is merely a presentation issue. So how many years are you presenting? Show the cumulative effect of the years prior to the earliest year presented. So in this one, we also have where we're presenting average cost. We also have our beginning retained earnings that's starting out as 5825. And we have the cumulative effect of our difference, which under average cost would be 150 and 50 for year 1 and 2. And then we'll add net income of 3710. And that gives us our beginning retained earnings for the next year. And we don't have to add a cumulative effect, and we just add net income for year 4. Just a presentation issue. Now let's look at an example of a change in estimate. Here, we need to calculate what the book value of our asset is that we're depreciating before we apply the new numbers to calculate depreciation prospectively, now that we have new information. Here we're told that machine A had a cost of $1.5 million, a salvage value of $750, and a useful life of 20. So the first thing we need to do is figure out what have they been recognizing as depreciation so far. And we would take the cost, subtract the salvage value, and divide that over the useful life. So for years 1 and 2, they've been recognizing $37,500 in depreciation. And the cost of this machine was $1.5, and we'll subtract $37,500 for each of the 2 years of depreciation to come up with what we have for the book value in year 2. So the book value is the cost minus the depreciation recognized so far, I like to think of book value as the depreciation remaining to be recognized. We still have to recognize expense for 1.425. Now, in this third year, we were told that they have re-estimated the useful life to be a total of 12 years. And this is very crucial to notice that they have said total, not remaining. They've said total, so that means there have two years have already gone by, so we have 10 years left remaining. Remaining useful life is 10 years. And the new salvage value they've given us is $650,000. So all we have to do with a prospective adjustment is to just calculate depreciation using the new numbers. So we'll take our book value, what's remaining to be depreciated, we'll subtract our new salvage value, and we'll depreciate that over the remaining useful life of 10. So depreciation for this third year and every year going forward will be $77,500. Now let's look at machine B, where we've been told that the cost is $825, and if the salvage value of $90,000 has been, and then they've been allocating that over 6 years, that would give us $122,500 in depreciation for this machine for the last 2 years. So if I take the cost of $825 and assume that I have subtracted $122,500 in each of the 2 prior years for a total depreciation of $245, then my book value in year 3 is $825 minus $245, or $580,000. That's the amount remaining to be depreciated. Now, they haven't given us any new information about the salvage value for this machine, but they have determined that it's going to be useful for 2 more years. Notice that this is giving us a remaining useful life, 2 more years, not a total useful life adjustment. So I can put 2 here for remaining useful life, and I can leave salvage value alone. It's still 90. I haven't re-estimated that. So the depreciation in year 3 and going forward, I'll just take my book value in year 3 and subtract the original salvage value. But I'm going to depreciate this machine for only 2 more years. So I'll be recognizing $245 for the next 2 years, including year 3. And that is a prospective adjustment for an accounting change that's a change in estimate. To wrap up, a change in principle is a switch between acceptable GAAP methods and gets retrospective treatment. We'll adjust retained earnings for the earliest year presented in our comparative financial statements. A change in estimate is new information and gets prospective treatment. Just use the new numbers going forward. And a change in depreciation method masquerades as a principal change, but is treated as an estimate change.